What is up, everyone? Welcome back to the channel. Look, let's be real for a second. We've all been there. You see a massive move to the downside. The RSI is screaming oversold. And you think, okay, this is it. This is the bottom. You hit buy. You're feeling good for about 5 minutes. And then, boom, the market just melts right through your stop loss. It's frustrating, right? The problem isn't your entry, it's your signature. You're looking for a turn, but you aren't looking for a confirmation. Today, I'm going to pull back the curtain on the reversal signature and confirmation model. We aren't just looking for price to stop. We're looking for the institutional footprint that proves the big players have actually flipped the switch. I'm going to break down these high-level concepts from mentors like GXT trades and T trades. We're talking V-shapes, AMD cycles, and the continuation key that lets you join a move even if you miss the start. So, grab some coffee, open up your charts, and let's get into the deep end. Before we get into the complex stuff, we have to master the basics. If you don't understand how a swing is actually built, you're building a house on sand. In its simplest form, a swing formation is a 3-candle pattern. Candle 1 is your setup candle. Candle 2 is the king. It's the lowest point in a swing low, or the highest in a swing high. Its wick must clear out both of its neighbors. Candle 3 is your exit candle. But here's where the real trading starts. We don't care about a swing formation that happens in the middle of nowhere. We care when it happens at a high time frame reversal point. Imagine this. Candle 2 isn't just a low, it's a liquidity grab. It's dipping into an old low or an institutional order block. When candle 3 expands away with speed, that is the market saying, liquidity has been taken, and we are ready to move. If you see a weak candle 3 that just lingers around, that's not a reversal. That's just a pause before more pain. You want to see that impulsive expansion. Now, let's talk about the V-shape. This is for the traders who like those sharp, clean moves. On the left side of this chart, you see a bearish expansion. It looks like the world is ending, but then, almost instantly, price hits a level and rockets back up. This is a V-shaped recovery. But here's the mistake. People try to buy the very bottom of that V. Don't do that. Instead, look for that blue line labeled CSD confirmation. CSD stands for change in state of delivery. Up until that point, the market was only delivering sell-side liquidity. The moment it breaks that CSD line, the market has officially flipped its state to buy-side delivery. Wait for the expansion candle to close above that line. That is your confirmation that the V isn't just a dead cat bounce. It's a structural shift. The same logic applies to a bearish reversal on the right side of the screen. Wait for that shift back to sell-side delivery. This next part is crucial because it's where most retail traders get hunted. Let's talk about high or low manipulation. Notice this orange dot at the bottom of the chart? The market makes a lower low. It looks like a breakout to the downside, right? But look closer at that label, SMT. SMT stands for Smart Money Technique. It's a divergence between correlated assets, like the S&P 500 and the Nasdaq, or Euro USD and GBP USD. If the S&P 500 makes a lower low, but the Nasdaq doesn't, that is a massive tell. It means the lower low you're seeing is manipulation. The big money is just dipping below that low to grab the sell side liquidity, all those stop losses from the long traders. Once they have enough orders filled, they rip the price in the opposite direction. If you see SMT at a key level, you don't sell the breakout. You wait for the snapback to go long. If you only learn one thing today, make it this. AMD, this is the rhythm of the market. Accumulation, manipulation, distribution. Accumulation, this is where price goes sideways. Most traders get frustrated here and start overtrading. Manipulation, this is the Judas Swing. Price breaks out of the range, usually in the opposite direction of the true move. It's designed to engineer liquidity. Distribution, this is the payday. Once the manipulation has trapped enough people, price expands violently in the true direction. Look at the orange dot at the top of that manipulation leg. That is the high of the day, or the low of the day being set. If you can spot the accumulation range and wait for the manipulation to fail, you can ride the distribution phase for some of the highest risk to reward trades you'll ever take. Finally, I know what you're thinking. What if I missed the AMD or the V-shape? Don't panic and chase the price. Look for the continuation key level. Even after a reversal, the market will leave keys behind. Look for the protected swing. This is a low that the market should not touch if the new trend is real. Wait for a pullback into an order block or a fair value gap. When you see price react off that level and give you another change in state of delivery, that is your key to join the move. It's a safe, confirmed entry that lets you trade with the trend rather than against it. Alright, let's wrap this up. Trading isn't about being a psychic. It's about being a detective. Look for the 3-candle swing. Check for SMT divergence. Identify the AMD cycle. And most importantly, wait for the CSD confirmation. If you start looking for these signatures, instead of just blindly hitting buttons, I promise you, your perspective on these charts is going to change forever. Huge shout out again to GXT trades, XYJ trades, and T trades for these. If this video helped you, do me a favor. Hit that like button and comment signature below so I know you made it to the end. Subscribe for more deep dives, and I'll catch you in the next one. Peace.